Okay, we've got some people joining. I will kick things off. So, hi everyone, my name is Michael Frazis. I'm portfolio manager at Frazis Capital Partners. My background's in chemistry. Been working in finance for about 10 years, and this fund is now in its third year of operation. Last calendar year, we did 39% net, and over the last 12 months, we've done about 46% net, and that has been over a period where markets are down. So I think what we're doing is quite different. I mean, obviously it has to be quite different if you're kind of deviating so much from, market indices. But I think it's quite interesting as well. I think it's like got a general, what we're doing is we've actually created like kind of a philosophy and a process around identifying some of the highest returning companies in the market, often highly controversial companies, and constructing a portfolio entirely of these. These are familiar names of things like Tesla, Afterpay, but we hold about 35 to 40 stocks. So most of them you probably haven't heard of. What we're really trying to do is just kind of fill that gap. You can have a huge portfolio of like maybe 10, 20 or 30 managers, or maybe just a few stocks, and not really have any of these, not have any of exposure to these kinds of companies. And in many cases, these companies are going 100% plus, but they're taking that market share from somewhere else. So it's kind of like, if you thought about it, you shouldn't be surprised that these companies are able to perform so well. They're truly unique in what they're doing. I've got some slides prepared, so I thought maybe I'd talk through those, maybe 10, 15 minutes. And then we've already got one question, but I'm very happy to answer any others that come up. Let me open that. I will assume you can see that. Okay, so this is us. So the three characteristics we look for, which long-term readers will be very familiar with, are companies with intense customer love, explosive growth, and market leadership and category creation. We found that those three things, generally all the best investment opportunities often seem to fit these. It's also a way you can use to kind of test whether a new idea is any good. Like, does it fit these things? It's also a way that we use to kind of constantly test our existing portfolio companies. Do they still demonstrate this customer love? Are they still growing? Are users still flocking to them? Would you call them the market leader? Is there someone else? Are you going for the second, third, or fourth player that might have short-term higher growth, but long-term will probably run into trouble? Or are you, investing in somebody that's a true market leader? For new people, there's quite a few examples of these kinds of companies. And as you can see, the performance is pretty stellar. They dramatically outperform whatever kind of comparable index you can look at. And just kind of like around that customer love home, it really translates into fundamentals. So Tesla, everybody drives one, loves them. The product is amazing. The stock was very controversial. The CEO is very controversial. The company and the CEO are not universally loved, but the cars definitely are. So when you saw this steep auto recession that we had early in the year, at one point, this is the first half. In the first quarter, I think at one point, car sales were down 50% plus. Tesla was able to actually grow through that. I thought this time, haven't we talked much about C? And we mentioned in letters and the other podcasts. I think this is one of the true interesting stories that I think it was just featured in the AFR, and they're probably syndicating it from somewhere else as the top performing stock, large cap stock in the world. Let's drill into what they're doing. They also just announced results. You can see it's pretty stellar, 93% growth on a pretty strong base. Now they have two businesses. They have e-commerce and gaming. Gaming is interesting. Gaming, they've got something called, their biggest hit was something called Free Fire, which is like one of those shooter games, like battle royale style, but it was designed for people, for smartphones with lower kind of specifications, lower graphics requirement. So it was a huge hit across Southeast Asia, India, South America. But the other side of their business is also quite interesting. It's called Shopee. It's e-commerce. Now this chart I think is quite interesting because it shows the opportunity. So C's kind of bases in Southeast Asia. It's coming like Vietnam, Thailand, Indonesia in particular, Taiwan. Those kinds of countries. And you can see here, there's how far behind in terms of e-commerce penetration these countries really are. And these are large, very young, very fast-growing companies. Where firstly, internet penetration is pretty low. Smartphone penetration is probably lower than you'd expect as well. But e-commerce is again surprisingly low. So you think about a company growing at 100% plus, e-commerce, GMV growing at 100% plus. and then think of like how much the market itself is going to expand over the coming 5 to 10 years. So there's a crazy opportunity here. China's the most advanced. So these numbers were mostly taken in May, so they do include a bit of a coronavirus bump. You can see China is by far the leader, followed by US. Australia is far behind, which probably suggests there's opportunity in e-commerce in this country as well. This is kind of what we talk about when we talk about explosive growth. They had 18 million of e-commerce revenue 3 years ago. Now they've got 1.8 billion. It's like 100x, and still growing at a prodigious rate. And then I get asked about multiples all the time. Somebody just wrote in and said, what do I think about sky-high multiples now, and how does that affect investing? I think for this style, if you hold something for 2 to 3 years and you've got something growing 100%, that ends up being the dominating factor by such a wide margin that, especially 3 years, especially when you go to like 3, 4, 5 years, it becomes like basically the only thing that was important. As exceptions, maybe if you bought the wrong company in 2000, maybe there are times when that would work. We're nowhere near those kinds of levels now. As you can see that the multiples contracted from 15 times sales to 7 times sales, 7.5 times, maybe more, 8. You'd think like the stock had, just saw this chart, you think maybe the stock had halved over this period, but it hasn't. It's gone from $25 to $135 now. So you actually want this. This is what you want. You want like something trading up here that is also showing these kinds of numbers. Like that is what will give you this. And if you happen to buy it here, the trick was just to hold it for a year, less than a year. It's really interesting to look at these charts, because when people think about valuation, I talk about it every day because it's the first and last question everybody has. I try and the more you see these things, especially when you live them, when you invest in these companies for multiple years, the more you see that, all that worrying was just broadly irrelevant as to, did you get customer love right? Did they maintain explosive growth, which is very much tied in with that customer love? And were they true market leaders? Because sometimes you see people who, I guess some people can generate explosive growth and some level of customer love, but aren't genuine leaders, and effectively just buying that growth and buying that love. So WeWork is a good example. This is kind of how we model them when people talk about process. So I just showed you numbers that showed they were growing at 93% average, and then maybe 7.5, 8 times now. So probably around the middle here on there, and probably way out to the right. And so if they average something like 50, 60%, which basically assumes their growth slows down to 0 over 5 years, they average somewhere around here, you're still looking at 3, 4, 5 times returns from here, after it's already more than tripled from when we bought it. This is another chart I like to show, which I have shown before. And this kind of demonstrates that same point. It's like, what happens if you overpaid for Afterpay in 2018? You're rewarded with the best performing stock in Australia. These things have resolved so decisively to the upside. You could argue again, look, it's up here and maybe it'll come down here. But generally what mattered was that the last 4 years that we've been holding it, they more than doubled every year. So 16 times growth in the company, and still growing over 100%. So in 12 months time, it's completely feasible for this company to be 32 times larger than when we bought it 5 years previously. And that's like the wealth generation that you'll get. We're not going for 20, 30% discounts and trying to get a 20 to 30% one-off. Really, that seems to be where some value investors end up. We're going to buy something 50% off. But if let's say you buy something and you're going for a 50% gain because you think that's kind of the valuation gap, what if it takes 3 to 4 years to get that? That's actually a pretty rubbish return. In many ways, it's got more in common with gambling than what this is. This is kind of riding these incredible growth trends, betting that betting on mean reversion and valuation closing some gap. There's no second step. So what? What makes it close that gap? There's an entire logical missing piece to that value approach that most people miss. I mean, this is very simple stuff. In terms of the broad philosophy, it's we want to ride these growth trends up. That's the chart. This is another one, Shopify. Again, this is a very small position for us. It was a larger position. But you can see that if you look at the light blue line here, which is the revenue, same as all the other charts, no matter how volatile the stock has been, this has been like a metronome. Afterpay was like this as well. Every update, more users, more revenue, much better, stronger, bigger company. And the share price followed, even though there were many bumps along the way. So what happens if you overpaid kind of here? You know, you got one of the top performing stocks, even before the latest like valuation uplift, which is probably like from here to here. This is actually what you want to own. You want to own these kinds of things. We'll take an exception here. So we're not investing new money in Shopify. There's companies that have these kinds of profiles, actually faster growth and trading on 2 to 3 times sale, focusing a lot of our attention on those. Basically what we're doing is we've got a whole portfolio of these things. Get asked a bit how we actually identify these things. Basically screen for growth, that's one way. Look for market leaders, that's another way. The curious thing is that each of these, most of the best returning stocks are companies that everybody knew. Like Afterpay was #1 last year. Everybody knows that company in Australia, certainly in the Australian investing community. It's similar with like Tesla, Netflix, the FANG stocks, like early days Amazon. You know, everybody knew these companies. You didn't have to go, I mean, you certainly have to filter and find the good ones and the market leaders, but there weren't undiscovered gems. You know, generally the question is, everyone knows the companies, and then you have to do the work and come to the right conclusion on the customer love. And basically, will that customer love translate into explosive growth into the future? Another way we get them is by looking at thematics. So Pinduoduo got us interested in e-commerce, which got us interested in C, which got us interested in Mercado Libre, which has been an astonishing performer. So C is probably #1 in Southeast Asia. Mercado Libre you could think of as, you know, #1 in South America. Slight differences. C's obviously got a very profitable, fast-growing gaming business. Mercado Libre's got a very fast-growing, you know, in some countries, 100, 200% plus payments business. So there are differences in companies, but again, it's like that's another way you can find these things. So, okay, you've got a market leader in this part of the world. Is there not one somewhere else? Oh, this is an interesting digital health company. Who else is in digital health? You know, what are they growing at? Which ones are the leaders? Which ones are other people following? And that got us into Teladoc and Livongo, which were fantastic performers. Happy to talk about that more. Then we sell. So what we do is, all these things should be very obvious and very clear. If you've got a market leader with explosive growth, you should be able to see that in the web stats, should be able to see it in the customer growth, customer retention, revenue growth. People should be willing to pay more for it every year. These things all need to line up. Once you start miss 1 or 2 of those drop off, generally that invalidates the thesis, and we're usually out. But yeah, I guess we haven't really realized any net gains in 2 years. And if you spoke to me a year ago, most of these companies would have been there. This is a topical example of Carvana. So these guys have these car vending machines, which looks striking. The idea is that you can kind of effectively, they wanted to create a nationwide, I guess, market, you'd say, of used cars, where everything was delivered the next day. To do that, they had to get basically trucks full of cars that, like, you know, travel around the distribution centers around the United States to try to create that liquid market. And there's so many things they can do. Obviously, if you want to buy a particular car in a particular city and the actual car is far away, they can adjust pricing and play around with that. But the idea is you don't have to haggle. You don't have to have that horrible used car dealership experience. It's transparent price. It's below the market price because they discount, systematically discount. You have a nationwide inventory, and the whole experience is seamless. You can just order it from your phone. They also offer a 7-day test drive, effectively, so you can hand it back with 7 days. So you can see that this is like a really compelling product. Like there's so many ways in which that is superior to the existing method of buying a secondhand car. Like the customer's clearly right. The investors hate it. I mean, short interest was 70% of the free float. They still do, broadly because the company was losing money. The black line is the short interest, which you can see has stayed sky high. We bought this at $36. It's now over $200. But again, you can see here, so you have clear customer love, and you can see clear explosive growth through these like kind of 100% plus figures. Just staggering. And again, we're riding this light blue line. That's my mouse. We bought this around here. We're riding this light blue line up, and I guess lately we've had a bit of multiple appreciation as well. But the true multiple is probably going to end up somewhere around here. You know, they're targeting 15% margins. So there will be some level of compression. But the multiple is also artificially high at the moment. I mean, Carvana, to talk about the market briefly, there's been a lot of things, particularly in e-commerce, that have like accelerated through coronavirus. When the vaccine comes, and I'm obviously more optimistic than most on that, there's a good chance that reverses. But there's some companies that were able to grow through the crisis and will also get a massive kick on the pent-up demand. I think cars are one of those things. think Tesla was able to grow through the crisis. They're going to have blowout years ahead. You know, when when people start buying cars again, I think Carvana's in the same boat. And people thought this was going to go under if they had a shock like this. They actually grew, maintained their margins more or less. And then when people come back, they're going to have significant market share. So if you're growing your market, you're growing your revenues and the market's halving, your market share is effectively doubling. This is why people didn't like it. This is actually why I liked it. I think it's good to bridge these gaps. I think that's what finance is for. Take a very fast growing company that's losing money and you take it to somewhere that's profitable. And they've gone from like minus 25 to kind of like maybe they IPO'd around here, minus 16, got an extra 10%. And remember, they're improving their margin while doubling revenues. There's no easy task. And then obviously a bit of a coronavirus dip and recovery back. We talked about opportunity a bit. This is something we picked up about $8 recently, like maybe a couple of months ago. It's now 27. There's a lot of opportunities still in the markets right now. We're looking at another company which I won't disclose. We're buying over the last few days. Same thing, you know, 100% plus revenue growth. You know, every individual business within that business was growing effectively their like for likes at, you know, roughly 50%. Those kinds of things are very compelling. And if you can hold something that's doubling every year for 2 or 3 years, that's going to get these true appreciations in value. I think that's why our returns have kind of been so strong, is because we've actually captured these uplifts. And in many ways, the market went down, went up, went sideways. It was irrelevant. You know, these companies are 5% larger every month. And so when we go through a period of, you know, where things are down, they just sit there compounding away. The underlying business compounds. You know, the investors panic and sell down the stock. The business is growing. You know, all of our portfolio companies not only grew through the crisis, but a significant number of them actually accelerated. So that's actually when you think of the true opportunities, when you see those kind of, there's like diversions between what the market's doing, and what people are thinking now. So in terms of questions, I had a question, what do we do with money when it comes in? Typically we'll allocate it to you should see the fund is pretty close to fully invested. There will be equity risk, and you know, it's a sad fact that sometimes months are down, and that gives a very bad experience if you're unlucky enough to invest right before one of those. But obviously we've generated significant returns. It doesn't matter, you know, where you invested. We've now performed quite well. The way we'll do it is let me stop the screen share. The way we'll do it is we'll allocate it to the best opportunities at the time. So for example, we talked a lot about a year ago about companies like Twilio, MongoDB, and Alteryx. Twilio and MongoDB had pretty good crises, but they're also right at the top of the valuation range. Alteryx is one of those ones where they kind of front end all their revenue. So their revenue growth significantly dropped. But it's a compelling product. People have, the net retention rate is still there. So my guess is that pent up demand sooner or later will come back. So very weak results now will translate into very strong results in 1 to 2 years time. And it's depressed. So when money comes in and we're looking at allocating to software, we'll be allocating far less to the higher, or probably none to the higher valuation, high flying companies, and much more to these, to the companies that, you know, represent much better kind of value points on the chain. Some things like e-commerce we will probably maintain as a pretty high weight. Digital health will maintain as a high weight. There's new life sciences opportunities we're looking at. There's a small handful of, you know, 50 to 100% growers that we'll probably allocate to. Generally, that's how we'll approach it. What are thoughts on C results overnight? Are you a buyer at these prices? I'm not a buyer at these prices. Well, I showed you a kind of table that showed the 5-year returns. If they just maintain, you know, 40 or 50% growth, they're doing twice that. I think my view is that you play for the 3 to 5 year outcome with these kinds of things. And it's definitely a buy over 3 to 5 years. That's not controversial. Whether it's a buy today or tomorrow, I have no idea. The results were solid. We won't know we won't know how much of the growth in e-commerce was coronavirus related, how much is a permanent shift in behavior for some time. But that's kind of in the future. My view is that, you know, e-commerce was already growing spectacularly. C is in countries where it's coming from a very low base. We know that it can go as high as 30, 40%. So my view is that's probably triggered a shift in behavior rather than being a temporary shift in behavior. But I could be wrong about the short term, but I have very high conviction on the 5-year view. Give you a pretty clear answer on that. Previously spoken at length about portfolio companies after paying zero. Are there any other ASX listed companies you're currently excited about? I mean, there's something that performed very well. I mean, something like Redbubble, that would be, you know, very fast grower in the e-commerce space. Again, huge coronavirus beneficiary. Don't go out and rush out and buy any of these stocks, please. I mean, I'm talking about stocks that have already moved a lot. And in many cases that we bought, you know, at a third or a quarter of the price. Or in something like Afterpay or Carvana, much less. So if I say I like that stock, it generally means I'm a holder. I don't feel like, some people think you should wake up every day and buy or sell every stock. You're the buyer or seller. I don't believe that. If you do that, you're never going to hold anything for longer than a few days. You know, you make your call. You say you're going to ride out, you know, you think there's 3 to 5 years of very strong growth. And then I think you sit and wait for that compound. Zero, love the company, but it's kind of an example of where we would actually trade out of something, because the multiple is pretty high at like 16 times sales. Growth has slowed down. It's got a level of maturity. I mean, my view is Zero kind of blew the opportunity. I mean, they were doing online accounting years before anyone else. I think they set up in 2006 or something, which is wild. This is like way before, you know, a decade before SaaS kind of took off the way it did, or nearly a decade. But they made a decision they wouldn't go into the United States. They'd focus on other markets. I think it was a huge mistake. And I think they'd still be growing much faster than they are now had they invested more earlier and become the global leader. Instead, they kind of just let the United States go. And then got a fierce competitor, a late fierce competitor there in Intuit. But yeah, there's plenty of exciting companies in the ASX. We do look at a lot of our small companies as well in the life sciences. But they're probably not the sort of things I kind of recommend on a webinar or podcast, because they're a certain set of risks. Reading recent updates, get the impression the fund strategy is simpler than it has been in the past. This is correct. I mean, my journey as an investor, I probably started maybe 12 years ago now. Even in this fund, I think we used to do derivatives, we used to do shorting. Generally, I just don't believe in it. And I just watch, you know, what actually creates value, and what's philosophically sound as well. Think about short interest. Let's say 100 long, 100 short. Sounds great. Okay, we'll buy C and we'll sell the retail index, which would have worked out well. And we actually had a similar trade on, actually. Like, while we're holding Carvana, we actually short the retail index. But what you don't see until you actually do it is how expensive those trades are. I mean, you're paying, it can be anywhere. Obviously, it can be really cheap, but it often gives you 3, 4, 5% a year just to borrow the stock. You're paying dividends, you're trading a lot. You're constantly having to adjust positions because the way the profits and losses on two sides of the book work means that, you know, you put 10% in the stock and it doubles. It might not be 20%, it could be anything. You know, there's no guarantees there. So imagine paying 3 to 5% a year for 10 years. And then I'm pretty young, in my early 30s. I want to do this for the next 30, 40 years. So let's say I do that for 3, 4 decades. So compound 5% at, you know, 30, 40 years. And you see you'll have to make a lot of money, and you can still kind of effectively be flat after that period. And that's the experience I see when I look at other long short funds. Not to kind of rip on anybody. You know, like I was long short for 5 years and did some crazy number, like I think it was 30% plus. Over that period. It was kind of 2012 to 2017, that kind of range, where a lot of funds did well. All you can do with long short is you can get the longs right and the shorts right for 3 or 4 years in a row, maybe 5 years. You show like basically a straight line, like very little market risk. The problem is if you get something wrong, if like your longs and your shorts don't work, and I promise you that will happen to everybody sooner or later, you might drop 30, 40, 50%. You know, you might, and without much happening. Maybe you lost 15% there, 20% there, and you're down 35%. You don't own anything. You've got like some kind of like artificial portfolio. There's no guarantee you'll bounce back. And you're under pressure, and you've probably got a few thematics wrong in that instance. So it's a very dangerous moment. You then got to try and figure out, that's why I see a lot of these long short funds kind of drop. They can have stellar performances and they'll drop and they'll kind of flatline. And the ones with really long track records, generally they're pretty mediocre. Because then add in the hedging costs, the fees, the interest costs, the fact that you get shorts wrong. Even if you have, you know, see guys boasting on Twitter, you know, 5% alpha on my shorts, whatever it is, you know, that you're still losing money, you're still detracting. So all those costs are just building up, and you can get so many things right, you can make so much money and still end up without giving your investors a decent return. So shorting is out. Complex derivatives, I think, similar. You can make a lot of money when you get them right, but they can also blow you up. But a simple strategy of being broadly unleveraged, long, just having a really clear idea of what you're going to do. Like the reason we performed well is because we didn't panic in March. I don't think the people that panicked thought they were panicking. I thought they were being responsible. I think they were saying, okay, there's a lot of uncertainty here. Let's tone down the risk. What that means is you're selling at the lows. I think it's responsible in most businesses. In this game, you've got to flip that. You've got to find a way to be a buyer and a holder when the market panics, and a net buyer. Whether you need to be a net seller at times like this after big run, I'm not sure. I do know for a fact that the real winners are long-term holders. So yeah, the strategy is super simple. It's super simple. 35 to 40 stocks, well, probably realistically, probably 30 to 40. And a few of those would be quite small. And then long-term holds, wait these things out. And then, most of the time, the long-term, you end up winning this way, I truly believe. You'll look stupid every now and then because everything goes down and there'll be a few people who've got the short right, a very small number, will then be on the front page of all the newspapers, and then the odds are most of them won't catch the turn. There's very few people who get the crash and then the turn. And that's pretty universal fact if you look back at all the market crashes. There are plenty of market geniuses who got the crash. Very few people performed well in the years after. But the long-term holders were kind of fine. The holdings in the fund equally weighted. Look, our biggest position is after 8%. I think something's gone up that much. You can see we've obviously have trimmed that a lot, sadly. Typically, the comfort zone is 3 to 5%. High conviction should be 5%. That is plenty. That is, if you get it right, you can add 25, 30, 40% to the portfolio over 4 or 5 years. Get it wrong, you probably lose 1%. It's great risk reward at that 5% range. Self-wealth. Yeah, I'm not sure about self-wealth. I mean, I guess the time, that a huge run up, and then the time when I spoke about it, their stats flattened out. So in August, they're now kind of record highs in stats in terms of web traffic, but there's no doubt they've kind of slowed down. So the question is, and I can't tell you yes, like buy or sell on this. Firstly, I'm not allowed, and secondly, I don't know. But the question is how much of, they should have international trading coming on. How much of the recent trading is new behaviors and how much is a coronavirus bump? That will probably be quite important. That question is actually important for a lot of stocks right now. Tanara. So I shared office space with Elliston. So that was a very helpful and nice of them to help me out so much. Tanara has a shareholding in the business and they've invested. We've set up a process whereby trades are signed off by them. Not to kind of like change what we're doing, but just to provide that level of oversight, and really to make sure everything fits the strategy and everything kind of works and coherent and kind of bind us to what we say we're going to do. And that's helpful. I mean, there's a lot of people in the markets that want constant information, want to see things go up and down and sideways. And, if something's happened, okay, we'll sell this, that kind of vibe. I think that's very unhelpful. I think you want to kind of step back, take the time to think. Having a formal investment committee kind of allows space for that and time for that. And that's kind of the relationship we have with them. They're an investor, a shareholder, helping us a lot with operations and also helping us kind of with the investment committee and oversight. Do I see downside risks to the fund over US elections? I think elections can be really treacherous. I think they're usually red herrings. And the United States is going to be the United States. The vast majority of people will go about their business before and after the same. My guess is, if I had to guess, I'd guess that whatever the first move is wrong, and then it just reverses and goes the other way. So think about when Trump got elected, and there's a huge sell-off, and then it lasted about half a day, but then turned into a huge bull market. So I feel like this is one of those ones where should you react on the news, you might get caught the wrong way. You would think in the abstract, if the Democrats win, that's probably more spending, potentially higher rates. There's two things could really shift the regime. And the regime's obviously working very well for us now. So thinking a lot about it. One is, a vaccine. The other one is rising interest rates. And a Democrat government that spent a lot more could potentially lead to that. People have been calling that for many, many years. Sooner or later, there probably will be an interest rate regime shift. Generally, the bet has been to not bet on that. I don't know if that's, this is something that started in the 80s, right? It's still going now, this phenomenon of lower and lower interest rates. If you look at the US, they're still positive. You look at places like Japan, EU, they can go a lot lower and stay a lot lower than they are now. I don't think interest rates would really, 2 or 3% move up in interest rates probably cause a pretty severe recession. My guess is the economy is very susceptible to small amounts of interest rate rises. In fact, you saw that. So in 2011, Trichet and ECB tried to raise rates in the Eurozone, basically caused the Euro crisis. I think he raised it 50 basis points. I can't remember if it was 1 or 2 raises. But he got it wrong and it caused a huge amount of trouble for everybody. 2018, Jerome Powell tried the same thing. Jerome or Jeremy? I can't remember. Anyway, tried the same thing in 2018. He decided to raise rates because everybody has this idea that high rates are good. It's like a moral good for some reason. And he seems to have had this philosophy and always wanted to do it. Came in, did it. Markets dropped 20%. You could almost see the fear in his eyes. Like he just changed tack immediately. So now where we are, fiscal stimulus negotiations. Now you've got, so how is this going to play out? So there's no austerity movement here. What's really damaging is austerity. That's what really caused all that Eurozone trouble. Those governments contracted spending at the same time their real economies were contracting. It was madness. I was in England when they did it. It's very good politics sometimes because you basically say, look, we're responsible. Don't spend more than you earn. Like playing all these like very deep very deep beliefs that people have. It can be very effective politics, but it's a disaster, economically. So compare what they did in the Eurozone. Or think about Greece, where they tightened it. They tightened into a depression, and Greece economic outcomes were worse than depression. It took them from like borderline, maybe prosperous Western nation. You could probably say that. To, kind of like poor Eastern European nation. It's almost like that kind of shift. Like that was how much wealth was destroyed. Shrinking population, young people leaving. Terrible services, terrible pensions, lots of people on the poverty line, huge outcomes. That's like austerity. I don't really see that now anywhere. I see like both sides of politics wanting to stimulate more. And you think about what happened now. The coronavirus has been basically a V-shape over many metrics. Had there been an austerity movement at the same time, it would have been a very different outcome. We'd probably be at new lows, if anything, in the markets, and terrible economic outcomes like those seen in the parts of Europe that really got ravaged by austerity last time. I haven't seen anything emerge that suggests that people want to rein in budgets. I'm seeing in countries like Australia, I'm seeing things like stamp duty reform. I'm seeing things like tax cuts, things like that that are going to be very supportive for markets and the economy. In a weird way, again, like just to refocus, like what we're doing is these things can all be red herrings. What we're trying to do is we're just trying to get sit on these lines. Where are these lines? Sit on these growth tracks across the portfolio, across 35 stocks, and ride that growth up and try and ignore too many of these bumps. I truly believe that is the right way to actually create real value. I'm not saying that's the best way to invest in markets or anything. I think it's probably the highest return though. It probably creates the most wealth. I don't think you need to kind of take it from me either. You can just see it in the results of these companies. Look back over your own experience of the last 5, 10, 20 years and think about where the true value creation was in listed markets. And I think you'll find that it comes with companies that have these characteristics. So this is it. Best investment opportunities, generally in front of our eyes. We systematically identify them. We have a portfolio entirely made up of these. When investors hate a stock, but customers love it, the customers generally win. So we focus on the customers, not the investors. And the true winners are the people that hold. And ignore the kind of like noise. I don't think you need to be like some crazy buyer that buys in the bottom of a recession. I think it's better to systematically just constantly invest in these fast-growing companies and ride the wave. And we thought, the amount of times I thought things were due for a down month or two and it didn't happen, then you're 20-30% higher. You could have easily given away 20-30% of performance, which is real money, just because you had some idea that things were overvalued or something. And then generally when things do look overvalued, often the growth comes through. often the market kind of gets it right. I think you saw that with companies like Shopify. Like, I thought it was way overvalued. I thought it was trading at 45, 50 times sales, but it wasn't. It was growing 100%. You know, its growth rate was twice what I thought it was. The company was significantly larger than I thought it was, and all those metrics were wrong. And the long-term holders win, as I think they generally do. So I'll wrap things up there. Feel free to get in contact. Email is michael@fraziscapitalpartners.com. If you want to have a chat or learn more, please get in touch. Thanks so much.